Markets made new highs this week. I don't find a lot of people cheering and happy. Most of our institutional clients are skeptical of this recovery because they feel that there's still looming uncertainties, whether it's the FOMC or the tariff deadline. So, as you know, markets don't peak when investors are skeptical. They peak when there's over exuberant enthusiasm. There's no signs of that. The Fed is on hold, but the Fed will resume cutting once they're confident inflation is not a problem with the tariffs. Now, I don't know the date that starts, but if the Fed becomes dovish, that's more central bank liquidity. That should benefit the financials. It benefits small caps, which are highly correlated to that trade, the regional banks, but it also benefits the cryptocurrency complex because that is highly sensitive to central bank liquidity.
Stocks keep breaking records, but you'd hardly know it by the mood on Wall Street. The buzz isn't a celebration, it's a wary kind of waiting. Big players are still on edge about everything from Fed meetings to tariff drama. There's this odd sense that, despite the rally, most people are bracing for something to go wrong. That's not the kind of wild optimism that usually signals a bull run is about to burn out. Market veteran Tom Lee sees this as a rare kind of opportunity. He's quick to remind investors that markets rarely top out when everyone's anxious. Instead, Lee is watching the Federal Reserve. If the Fed shifts gears and starts cutting rates again, he thinks we could see a major ripple effect, not just for stocks and banks, but for Bitcoin and the wider crypto market too. After all, liquidity is rocket fuel for riskier assets. Bitcoin has always danced to the beat of macro policy. When inflation cools and central banks hint at easier money, Bitcoin usually finds its footing and starts climbing. If the Fed's next move is indeed a dovish one, we might see Bitcoin leave its recent hesitation behind and make another run for the highs. Let's bring you more clips from Tom Lee's interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
You continue to say that this is the most hated V-shaped rally. Is it still?
Yes, markets made new highs this week. I don't find a lot of people cheering and happy. Most of our institutional clients are skeptical of this recovery because they feel that there's still looming uncertainties, whether it's the FOMC or the tariff deadline. So, as you know, markets don't peak when investors are skeptical. They peak when there's over exuberant enthusiasm. There's no signs of that today.
They're not wrong with wondering about the uncertainty relative to those issues, are they?
They're not wrong, but I think it's the amplitude that people got wrong. So in April, people thought if you didn't have a trade deal, we'd have economic Armageddon. But now what they're finding that is if you're wrong, it's just we don't have to fall off a cliff. And so there can be diplomatic solutions or even pushing off deadlines.
Okay.
You know what? There's $7 trillion of cash on the sidelines, and retail investor sentiment, I think you have to really fracture it. I think the Robinhood community is bullish, but what I'd call the high net worth and the traditional equity investor is still pretty cautious. That's the heart of our universe of clients. So I'd say that speculative activity, it's kind of, those are such small examples that I would say it's way too early for me to say they're speculation.
Such small examples. I mean, the high beta ETF has been hitting record highs almost every day. But we're not talking about garbage stocks.
Sure, but high
either.
beta as an ETF, if you look at that, it usually should lead in a bull market. So it's not unusual, just like momentum MTUM should lead. But the thing to keep in mind is that in 2021, when Goldman cites that data, people were speculative excess in these big Mag 7 and these large cap names. There is hardly any euphoria in those stocks. But if I were to define speculative excess as someone making an assertion that is not based on current fundamentals, but then believing that their view is correct, right? That's a speculative bubble. There's a speculative bubble that inflation is coming back, and there's a speculative bubble that we are on the precipice of a recession, because that is probably the most common conversation I have with clients. And every Zoom I've done with an institutional account, always 5 minutes in, someone's like, Tom, how come you're ignoring all the risks out there? Don't you realize we could already be in a recession? So I think there is speculative excess in the fact that we're in a recession.
And negativity.
Yes, just like there was a bubble of pessimism after GFC. Remember from 2009 all the way through 2019, it was a bubble that another financial crisis was coming. It was
we
a bubble
had
of pessimism.
PTSD, Tom. I mean, that was just not a regular occurrence.
Correct. That's right. And the market today has PTSD of trade and the Fed. The Fed is on hold, but the Fed will resume cutting once they're confident inflation is not a problem with the tariffs. Now, I don't know the date that starts, but if the Fed becomes dovish, that's more central bank liquidity. That should benefit the financials. It benefits small caps, which are highly correlated to that trade, the regional banks, but it also benefits the cryptocurrency complex because that is highly sensitive to central bank liquidity. So I think the banks and the financials and small caps and the cryptos kind of move when the Fed becomes dovish. The financials have recovered, but they still haven't become expensive. And that's because there's another lever that gets pulled. When you cut rates, then mortgages become affordable, and it actually expands the credit cycle. And keep in mind, the ISM has been below 50 for 29 months. That's the longest stretch in the ISM's history. So I think we actually, to Chris's point, if the Fed starts cutting, I actually think we have a cyclical recovery that is good for cyclical stock. We have 15 million household formations in the past 10 years and only 13 million homes built. So we have a shortage of housing that's worsened because interest rates are high, that is actually causing home prices to stay elevated. So I think there's a policy problem. And the other thing to ask is, if trueflation, inflation's at 1.8 and core PCE is at 2 and the Fed's at 4.5, it's very difficult for the Fed to explain why they are keeping real interest rates high, which really hurts consumers. So I think there's other policy measures that can be done to slow the economy, including the fact that there's all these tariffs in terms of taxes for businesses. So if someone told me there's $400 billion taxes going on to the economy and said the Fed has to stay tight, it's counterintuitive to me.
Markets are hitting new highs, but you wouldn't know it from the mood on Wall Street. Instead of excitement, there's hesitation. Institutional investors remain cautious, clinging to concerns about inflation, rate policy, and global trade. It's a strange kind of rally, climbing steadily, yet unloved by many. Skepticism is everywhere, and ironically, that might be exactly why the rally continues. Markets don't usually peak when everyone is bracing for the worst. They peak when no one sees risk coming. A lot of this hesitation stems from a misunderstanding of scale. Earlier in the year, any delay in trade deals or signs of sticky inflation sparked fears of an economic cliff. But the drop never came. What's playing out instead is a slow adjustment, more policy maneuvering, fewer disasters. And while retail traders are dabbling in momentum names, broader participation remains muted. There's still over $7 trillion sitting in cash. What's quietly unfolding is a liquidity-driven shift. If rate cuts return and policy turns looser, capital will flow, boosting small caps, financials, and risk-on assets like Bitcoin. The pessimism still lingering from past cycles is blinding many to the strength beneath the surface. This isn't euphoria, it's disbelief, and that's often the beginning, not the end. Let's watch more clips from the interview.
I think many people, when April happened and we had Tariff Armageddon and the market went into a free fall, investors liquidated because they thought we were entering a recession. But, and as you guys had covered, like the market then staged a V-shaped recovery, which caught many people off guard because they wanted to have a chance to get in. They wanted the stock market to be like a K-shaped or flat line. Instead, it was a V-shaped bounce. And so most investors are underexposed at the moment, and they're trying to look at headlines with a half-empty view. But as you guys know, earnings have actually been really resilient, and I think it tells a very good story.
Yeah.
What we're saying is, instead of someone saying, oh, the MAG is making the market expensive, let's just take the average PE of the S&P of every stock, and it was around 17.6 times in 2019. Now we've had 6 what I call extinction-like events, COVID, the bullwhip supply chain effect, inflation surge, Fed fastest hikes, Trump tariffs, and then, of course, U.S. bombing Iran.
6 of them, yeah, okay.
Yeah, all of them should have wiped out earnings, but the S&P earnings have grown, and yet the equal weight PE is now 16 times. So the market's gotten cheaper in the last 6 years, despite proving they can grow earnings through 6 extinction-level events. I mean, to me, the Mag 7 have become household names. You know, like Apple is Apple and Google is Google, and we know the product and we know the stock. And I think they have really established themselves as consumer and business companies. And for me, Apple has been sort of quietly ready to pounce on AI, but I don't think they need to pay up for any of these models. So I think Apple is going to surprise people. I think the 200 to 250,000 for Bitcoin still makes sense because that would still only value it at 25% of the size of the gold market.
Okay.
So I think digital gold means Bitcoin should be worth over $1 million per Bitcoin, and it could happen in the next few years. But maybe pricing 25% of that, especially with Genius Act, makes sense.
Are you going to, I don't know, start making comments and recommendations about stablecoins?
Yes. I mean, in a sense, stablecoins are the ChatGPT moment for crypto because businesses like it and consumers are adopting it. And now we see JP Morgan and Citi and getting into the stablecoin market, and the Genius Act, of course.
How would you play that?
Well, Circle is one way because it is, a standout company. They've done really well. But Ethereum is really the way to play stablecoins because the majority of stablecoins are created on Ethereum. It's over 30% of its network fees. And if Scott Bessent's right in it, he says now it's close to a $4 trillion market. That's exponential growth for Ethereum.
Markets took a wild ride when tariffs first rattled nerves. But instead of grinding lower, stocks launched higher in a snapback rally that left cautious investors in the dust. Many who waited for a drawn-out slump ended up missing one of the sharpest rebounds in recent memory. Even now, as headlines stay gloomy and talk of risk dominates, earnings have quietly held up. Corporate America has weathered everything from the pandemic to aggressive rate hikes, and instead of overheating, market valuations have actually cooled off, a far cry from the excesses you'd expect after such a run. Meanwhile, the tech landscape is quietly shifting. The hype around artificial intelligence is reshuffling the leaderboard. Some household names are pausing, while others are quietly building for the next leap. In crypto, Bitcoin's narrative is far from finished. Talk of six-figure price targets is moving from wishful thinking to a plausible scenario, especially when compared to gold's standing in the investment world. And if stablecoins are having their breakout, Ethereum might just be the engine behind it all, driving a new wave of innovation and possibilities in digital finance. It's not just a comeback, it's a reimagining of what comes next. As we wrap up, do you agree with Tom Lee that skepticism means the market rally still has legs? Why or why not? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.